Inheritance tax, IHT, is a tax on the estate, property, money, and possessions of someone who has died. In the UK, it is typically charged at 40% on the portion of the estate exceeding a £325,000 threshold, or up to £500,000 if passing a main home to children. No tax is usually due if assets are left to a spouse, civil partner, or charity. Timings. Key aspects of inheritance. Tax threshold, nil rate band. The standard tax-free threshold is £325,000. Residence nil rate band. An additional allowance, up to £175,000, applies if the main residence is passed to direct descendants, children or grandchildren, potentially raising the threshold to £500,000 per individual. Transferable allowances. Married couples and civil partners can transfer unused thresholds, allowing a combined tax-free limit of up to £1 million. Tax rate. The standard rate is 40% on the value above the threshold. Reduced rate. If 10% or more of the net estate is left to charity, the tax rate on the remainder may be reduced to 36%. Exemptions and gifts. Spouse or partner. Assets passing to a spouse or civil partner are generally exempt. 7-year rule. Gifts made 7 or more years before death are typically exempt, known as potentially exempt transfers. Gifts made within 7 years may be taxed, though some exemptions exist, such as the £3,000 annual exemption. Businesses and farms. These may qualify for 50% or 100% relief. Who pays and how? Inheritance tax is usually paid by the executor of the will or administrator of the estate, using funds from the estate, usually within 6 months of the death. Please remember that nothing, and I mean nothing in this video, is financial advice in any shape or form. For the love of greatness, always do your own research. Money matters because your financial education is extremely important.